guys, it's October the 13th, and today has been the weirdest day. CPI came out, traded down, now traded up just as much because we're just going to have this crazy volatile moment. I'm going to go through a couple of things today. I'm going to go through CPI data that came out. I'm going to save FOMC. I'll try to do it this weekend so you guys can get a good read on what was said versus what's being reported, because there's all kinds of special going on there. The markets are up. As you can, past performance, not indicative of future returns. The markets, as you can see right this minute on the mark, are up anywhere from 1 to 2%, depending on which is your favorite market. And oil is still under 90, which it should not be, but it is nonetheless. Because what CPI really told you is that the US isn't slowing down in a meaningful way. And I'll show you, like, it's a really strange number that was reported, so strange. I'll show you guys that in a second. And then I want to talk about Delta, BlackRock, and one other today that I'm going to tell you about that reported earnings. Yeah, no, it's actually just Delta and BlackRock. And then I'll just preview some of the other guys and what they said on the earnings calls that I've been looking at thus far. When we look at FinViz, the crazy thing, I mean, Amazon down 2, I kind of get it because it really, I mean, this CPI number just demonstrates exactly what it is people are spending money on. So like, am I going to chase it and continue to pound it down? It's just a really weird market. Technically, things are not great for them. But honestly, this whole rally within financials, with the exception of a couple that just have franchise names like Visa, MasterCard, Berkshire Hathaway, I have nothing against. There was nothing in this there was nothing in this report from BlackRock that would make you be like, oh my God, the financials are awesome. In fact, if anything, I saw the exact opposite. So I'll go through it with you. And also, wow, I don't know, Larry Fink was really, like, I have so much respect for what that guy's accomplished. He raises assets like no one's business, but he was really upset on the call today. And that tone was just fascinating because you don't usually get that agitated of a CEO. So let's keep that in mind as I'm going through things as well. Okay, CPI came out today. And I got to tell you, I mean, formatting is everything on these. So I've tried to like really highlight it. This is what was expected so that you can do the comp, right? So the headline CPI number for the index itself on the quarter was supposed to be 0.1. You got 0.4. And that was the first initial like clobbering reaction. However, it almost seems like someone was out that usually does this, because these numbers don't sync up in a way that makes any sense to me. Usually you don't have this kind of 3-point variation or 30 basis point variation on it, and then have all the other numbers look actually okay. So like core CPI, 60 basis points, 0.6%, that came in line on the core. So in theory, that would mean that you would expect food and energy to have done something truly crazy, but you didn't get that. So year over year CPI 8.3, it actually came in at 8.2. So this someone, they must have let some, this is like, it's not normal for it to be this all over the map. You shouldn't have CPI up 0.4 in September, but in like worse than expected, but somehow 12 months better than expected. That doesn't make any sense. Okay. And then 6.5 for the core versus 6.6. How is it that core came in line and yet somehow on the year it didn't come in line? Like, it's just like somebody, I wouldn't be surprised if the revision on this month is weird, but unfortunately it also means they can't use the CPI number in any kind of meaningful way to be thoughtful. I can show you what it shows, but even I'm, because of this stuff going on, a little bit concerned that there was maybe a spreadsheet error or something going on, to be fair. And then, core CPI year over year, 6.3 versus 6.6. That doesn't make any sense, right? Because core can't be up 6 point and then have this be down 8.2, but then you have this number, which would suggest that it should be in food and energy, but this number is actually fine. Something's not right. Okay, my suspicion is these numbers probably are right, because these do reflect what we're hearing from the companies that are reporting. And what we're hearing is that food is going up a lot and energy is going down as far as pricing goes. This we can see off the indices. So this probably is correct. This is also probably correct. We're seeing it mostly in cereals and baked goods, up 0.9. It's slowing its aggressiveness from previous months. I'm okay with that because we have this thing called harvesting wheat that happens in this like little period. So really, we should have seen a little bit of a dissipation within food relative to the month prior, but still up year over year, because what's been happening in food is escalated dramatically in the last 12 months. So that kind of is what it is. Fruits and vegetables up 1.4. The way that I think about that is that basically we used more acreage to make the thing that we really desperately need to keep to feed the globe versus feed us locally here. And it's the shortage that we're having in fruits and vegetables relative to grain that has fruits and vegetable prices up so much more than grain. So that's how I actually am suggesting, that's how I'm interpreting that, but maybe some people disagree. When we go down to energy, what I really want to highlight here is that yes, all of the energy commodities are down sequentially year over year. This is what we talked about yesterday, where I said, it's going to be really hard with the CPI number because last year we're starting to get comps that will look more like flat to slightly down because we started to have oil prices surge into the 70s, 80s, et cetera. So next quarter, I also suspect, depending on what the curve actually does, but it looks like we've stayed under 90. So it should look like a very specific sort of comparable to next year. And then we have the surge well over 100 thereafter. So energy is going to continue to look a certain way. But, and this is kind of intriguing, energy services, which is basically your gas and electric bill, that the prices are not coming down. And the prices are not coming down there because of labor costs, because of other things that are going on there that are pretty ugly. You can't trick energy services the same way you can trick energy. You can trick energy by just manipulating the markets, which is, as we know, even the UN is asking the world to do that for better or for worse. I'm not saying anything conspiracy theory, but kind of there's no reason for oil to be under 90 right now. So I'll just say it that way. Now, the one thing I would say is on new vehicles, that actually looked really good. So this morning when Tesla got pummeled, I was like, this is a joke. And my colleague, who you guys also know and love, Richard, went long. He probably did the better thing. I should have probably doubled down, but the market was so aggressively red. I was just like, are we just going to be jerks about this market or what? Anyway, new car sales actually were very strong and continue to be strong. At this point, they're up 9.4%. And you can see very clearly in CPI that is at the expense of used cars and trucks. And now there's a couple dynamics going on here that I think people forget. Number one, the US government is still subsidizing cars. It's subsidizing green transition to electric vehicles. And that actually is making new cars very, very competitive relative to used cars. The second thing that's happening is that we have a really old fleet in the United States. We have not replaced the vehicles that are well past depreciation. So when you get in an autos accident, your claim is so ridiculously nothing at this point that there's not used cars for you to change into. So I actually think this is just a weird, funky dynamic that is a function of how undercard we are here in the United States without, we got a shortage of cars. Let me just say it that way. Okay. And I think that's what this is showing more than anything. Now, the other thing that I would mention is motor vehicle maintenance and repair up 1.9. So that gives you that also kind of supports my argument for the new car stuff. So we had CarMax come out, not great. You can see my video on that. Carvana hasn't come out yet. They reported really, really well, actually, for what it is, in June. So they'll come out kind of later and report. So the used car guys are seeing a very different dynamic than the new car guys. Okay, now that's CPI in a nutshell. So those are my takeaways, but I also think that this is going to be a revision because someone, I think, screwed up. I could be wrong, and probably there's an analyst there that wants to kill me, but kind of is what it is. All right, now let's go to the earnings reports that we saw today. Okay, I really listened to BlackRock, Delta. I listened to a bit of Walgreens Boots. That was no good and actually concerns me for some of the COVID related stocks because that's where they weren't able to make a comp comparable to the prior year. But I really want to go through the numbers because I also may be unique to Walgreens since it was so much worse than Rite Aid. But I am going to go through Delta and BlackRock very quickly because the market is not giving them okay, so you know what, Delta, you guys are driving me crazy. I'm just going to say it this way. Please stop comparing yourself to 2019. It makes me insane. I barely have coffee. I have to go through 400 of these during earnings season. Please do a girl a favor. Stop comparing yourself to 2019, or like so many people will do, just add the 2021 column, because I think that's why your stock traded down to almost 27 despite a really strong earnings report, in my opinion. Okay. You got to stop that. It's so painful. Okay. Now here's what we had. We had revenue up 52% year over year. They're basically the Q from last quarter. Luckily, the IR website is a little bit easier to navigate than the IR stuff that's put out. So revenue up 52%. Cargo revenue down 9%. This matters because we also saw this with FedEx. Other, which includes the refiner, by the way, up 236%. Now, as you know, we love IEP. We love a lot of the companies refiners. There's a little bit more nuance to it in Delta. Okay. So they do have, it's really hard in these numbers, the way they currently report, to pull out the profitability of that refiner. But they did say it as a one-liner that the refiner helped them out this quarter on fuel costs. So we're just going to take it as the refiner's doing fine. Okay. Now, passenger services and selling expenses were up 78%, but the real thing that made the number look like a down, whatever you want to call it, 140 versus 2.2 billion. The real reason why it looked like a down EPS, and why this looked at first, and this is why you guys have to stop doing this on your earnings report, for 1.4 billion versus 2.2, is because of this one government grant recognition. And when you take that out, that 1.8 billion, then what they actually did was 1.4 billion in operating income versus 383 million in operating income, which is a 380% increase in EPS. Now, that is why you can imagine, as poor analyst me, barely any coffee in me at that point when this call happens at 10 o'clock, I'm really annoyed. I got to go drag the other numbers to just figure out what happened. Okay, this is kind of a little bit more detail. But again, they only give the revenue detail. They don't give the profitability. And I do think they took a few extra costs on the refiner because their refiner is a little bit older. So they do have some CapEx there that's a little bit different from some of the other refiners that we love, AKA IEP, which we're always promoting whenever we can. But nonetheless, the refiner was up 30%. Miscellaneous, by the way, stop calling it that, guys, at Delta. That's my second biggest pet peeve. But if you just did the first thing, I would get over it really fast. Miscellaneous is club access. It's lounge access. That's what it is. And look how amazing this performance was. Lounge access was 233 versus 161. It was like up almost 80% on the quarter. That's amazing. And that really does speak. And this is why you guys need to stop doing your earnings the way you're doing it. It speaks to their strategy. And their strategy has been, we believe that people kind of want a certain type of experience when they travel, and the lounge is a part of it. And the only other thing that's in this miscellaneous is still, I'm going to call it lounge access, because it's really the American Express business that they have, and the revenues that come from their relationship with American Express. So it's all the extra stuff that you're paying for that credit card for. Okay. Geo mix. I just want to show you this because this is very relevant. This again is they're comping the changes to some. I couldn't even make sense of it, so I thought I'd just give you the number, okay? So I did the numbers because this is comp to 2019. You know what I mean? But all of us in America and all over just want to know, where are people traveling to? Okay, if you were to, this is 2021's numbers, and you can see that the recovery relative to last year is significant. The only remaining area that really has not recovered yet, and this is why we do so many the only remaining area that has not fully recovered in any kind of meaningful way is the Pacific. Okay, the Pacific is Asia, Australia. And this is part of the reason why we still watch China, and we did our special on China on Monday. It's not because we are big into, walking outside of our lane and going to Chinese stocks and trying to find something there. It's really because companies that have China exposure still haven't gotten the benefit yet, largely speaking because of all the reasons that we spoke about in our episode on Monday, because China hasn't reopened. And a lot of that is a big wild card that we'll find out about after the CCP meeting that happens on October the 16th. But nonetheless, in the current stages, that business is the only part that hasn't recovered, but it is up. 244% versus last year's travel. Domestic is up 41%. So people are absolutely flying again. Europe, which is with their big, like we're going to turn towards Europe, we're going to be there on those routes as we move forward, up 316%. So it's actually working. People are absolutely taking the flights. He spoke a lot about the fact that one of the things that helps the airlines that is under considered is that all of these dynamics that people have, planes, people aren't buying planes anymore, slowdown in economy, there's uncertainty. So certain airlines that don't run a decent operating cost are not flying. The regionals are having difficulties flying and making that profitable. And then the shortage of pilots, all of that is actually leading to a shortage in supply that's making this industry act countercyclical. So this call should have been mad bullish for all the airlines, but just look at how they've performed since this morning, and you'll see that there's no one there for whatever reason. Okay, that's it for the airlines and Delta. We'll see, because American has a little bit more Latin American exposure than Delta. And so that already recovered in previous quarters. So up 16%. Hard to say how strong that is, but they also are very strong in Europe, American. United is very strong in Asia, so it'll be interesting to see, but a lot of the flights really depend, Japan, major hub, but also the 3 areas that they used to fly into on China. China's still going to look a certain way because the lockdowns have gotten more severe in the last month as we go up to the CCP conference. Okay, BlackRock rallying on earnings. I mean, at first it sunk 12% and you saw all this stuff, but I think when you look at the markets, you're like, was it a good quarter? Wasn't it good? I can't tell given how the markets reacted. Let's be really clear. It was not a good quarter. Larry Fink sounded really upset. Okay. And he sounded upset for a couple of things that even I kind of feel bad about a little bit, because I did. Okay. He felt very upset that people were saying that they're losing assets because they do have quote unquote net inflows. Okay. The thing is, I'm going to actually break this number out because you have AUM down 16%. So you have down AUM, but you have net inflows. And let me show you how to walk you through that. But in a short sentence, BlackRock's down 16% AUM and having positive inflows means that people gave them money despite their lack of performance. And oh, by the way, the performance is bad, Also, this right here off the top line demonstrates the challenge that a company that's this large has as relates to economy of scale. Okay. So that also is an issue. They're not the only ones with this issue. Most of financial services has this issue. So it really shows you how intense when this cratering happens on the asset side, how much that compresses margins. That's the first thing to note. Okay. Now let's actually then break down why it's not good. It's not good because here is the loss. Okay. You would have expected maybe it just came from one place within the markets. It didn't. It came from every single asset class and market product that they provide. That's bad. That's really bad. That bodes very poorly for tomorrow when we see, at least for the asset management piece of these businesses. Because here's the thing, BlackRock, no one has more assets on as an asset manager, as a company that you give money to run assets. No one has more than BlackRock. So you kind of get a sense for what's up. Now, some of that is explained by foreign currency, but not most of it. Okay. Most of it really is flat out, we didn't perform. And if you actually added that back in, I mean, it's just, yeah, it's not good. Okay. So then the other thing I would mention, they moved clients from passive to active. So you do see the one place you see inflows is right here, fixed income so you see inflows and fixed income ETF, which is a very low margin business for them. And then on the institutional side, you see a bunch of positive inflows here. And on the index side, the institutional index side, which is basically, they have the mandate to, do basically their index business, which is like the, oh my gosh, I can't remember the BlackRock funds, like the S&P isn't theirs, but some of the other ETFs, the MSCI ETFs are all theirs. MSCI Europe, ACWI, things that you're trading there, the thing I short all the time, MSCI Germany. So all of that had outflows, all of it. And it basically, you had an overwhelming greater amount in active management So that's inflows, right? So basically they did take, so despite the fact that they basically took all the institutions and upsold them, right? They still had lower margins, and that might just be the initial onboarding or whatever it might be. It's hard to say. So that's maybe the one glimmer of positive within this earnings report, because if the market corrects, then they've got more active money than passive money, whatever you want to call it. But overall, it doesn't, I mean, really, kind of is what it is. I would say the other thing is that this massive exodus from the index business, and he was really upset. It was really interesting. So the thing that he was upset about is the video. I mean, I didn't realize so many other people were saying it to him, but I guess there are a lot of people saying this. In the 4 things you missed on Berkshire Hathaway, one of it had to do with the fact that the index providers have an abnormal percentage of the total shares outstanding of all public companies, particularly large cap. And so then who gets to vote and what political objectives they have if they're pushing ESG, which BlackRock so clearly is. He took a bunch of questions the first time ever on this call about that aspect. In the past, he's taken questions about whether or not ESG mandates made sense and how aggressive his particular style of that mandate is, as it did not include nat gas for a long time. And now it's like we've kind of backed off of what we mean by ESG. Nonetheless, it's a thing. But he was very upset in talking about that. And he talked about the fact that most people that are in these funds have the ability to vote, that he put that functionality in, la, la, la. I don't know why he said that. I'm going to tell you why. There is no possible way that, even if it is a functionality, there's no possible way that this whole bucket, this retail ETFs and the index business, which is still a lot of money. It's like 22 billion, 65, or sorry, here, we got to go all the way here. This 2.7 trillion and this 2.5 trillion. So this $5 trillion amount of money, there's no possible way that in these ETFs, they're getting notifications from every single component company of those ETFs to vote. There's just no way. Why would you say that? So I think what he's talking about is this 371 million and this 163 million. And that is not what everybody's upset about. Okay. They're upset about this $5 trillion portion. Anyway, so that was a thing on the call that I thought was really, really strange. The other thing that I think really, on my notes, sorry, I didn't come up with a prettier slide, but this thing also really bothered me on the call that he got asked about. So he said, they were like, hey, so in this alternatives business, you want to talk about what the pension funds had to do with this whole collateralization stuff? And apparently, and I have to investigate further, but so this, like, the call literally happened this morning, there were some financial institutions that had a structure such that it was structured as a swap. And because the rates, Bank of England increased rates so aggressively, decreased rates so aggressively, it triggered the swap to happen. And then some of the pension funds had to post collateral and they didn't have it. Okay. I was like, they didn't have it. What? I mean, that's really not good. And although this impacts probably countries, pension funds are oftentimes you have like companies that are pension funds, but the bigger ones are all countries. Let's just be clear. In some cases, and he wasn't super clear on this, in some cases, it just had to do it was a mechanical issue that they didn't have the other side of the swap at the time they were supposed to have it. And that's just a function of routing of systems, which are archaic, particularly in Europe, right? I'm just going to call you guys out because I know y'all like to call us out in the US, but they didn't have it. And that actually caused some problems. And that actually has bigger implications, because if you have a risk management issue at the pension level, it's not great. And that really scares me going into tomorrow. Even if the market rallies, I think I'm going to be very nervous, but I'm going to really want to hear what Morgan Stanley and Goldman Sachs in particular have to say, because honestly, they have some of the best risk management on the street. Like Credit Suisse, all these other, like Goldman Sachs is absolutely known for its risk management. You can just review how fast it came out of every single crisis over the last 30 years and you'll know what's up. In fairness, the bond market crisis didn't affect them as much because they're not as exposed, but I'll be listening very closely for what's up there. And with that, I will stop share. That's why I'm nervous about the financials. Hey, David.
Hey, I'm stopping this. Okay.
Hey,
Hey,
Richard.
hi, May. Yeah, excellent. I want to introduce Richard, who does our intraday trading by Zoom. Richard,
Yeah,
are you
you had a
there?
great and fun morning with that swing, huh?
Yeah,
Yeah,
he bought
I am.
he bought Tesla on the lows, and since Tesla's such a popular stock, can we elaborate a little bit on Tesla? Thank you.
Well,
Oh,
I
yeah.
am here, but I'm leaving. I have a 1:30 demo.
Oh, no. Sorry, I had a lot today. Earnings is always like that.
Okay, you got 3 minutes.
Okay.
Well, I have to start the Zoom, so I only have two.
Okay.
So my deal on Tesla is I drew a channel on Tesla that ran all the way from uh, the low of, I guess it was May of 2021,
Mhm.
or at least the trend line, and it hit it yesterday, and of course it held this morning. And I used a previous low from May 18, 2021 as a signal to give me some indication whether Tesla was going to be able to hold or not. And since it held on that low, it broke through, but it still held, it didn't decline. Then I'm really bullish on Tesla. I've got a 260. What is my target? I have a 263 target on
Isn't
Tesla.
isn't there a gap there, Richard?
There's a gap, yeah. So the gap
Wow.
starts actually at, oh gosh, sorry. So the gap starts at 257.50, and then it's closed at 262.47. So, but I'm sorry, I do have to jump. I've got to start this Zoom. It's a big customer meeting.
Good
I'm
luck.
sorry I didn't get a chance to share. So
No, it's super
it's nice to
okay.
see you,
Super
May.
cool.
That's
We'll catch
perfect,
up. Good to
Richard.
see you too.
Okay.
Sorry it ran so long. There's just earnings season is always a weird start for me. But
That's okay.
yeah,
Tesla's a beast.
May, you said the earnings on Tesla, maybe not earnings, but that CPI report showed good car sales, right?
yeah. I mean, they should have been up immediately off of CPI, in my opinion, because like it's just another iteration. Look, Tesla's not expensive from a valuation. People keep trying to push me on valuation. I'm like, look, these last few quarters have been great. As much as Elon is a special guy. I like a little bit more conservatism in communication. So I get it. I totally get it. But the man knows how to run a business, and he's actually put some better people in his barrage of folks that work with him. His IR guy is actually really presenting the numbers in a way that is clean, so that you don't actually worry that there's some other weirdness going on. But those were really good numbers this last quarter. And if you look at what they look like, it looks like he's trading at a P to growth that's like under 50.5. So they are growing well past what that earnings is, whether you look at earnings like I do, enterprise value EBITDA, or whether you look at it, which you should, because there's a lot of depreciation. He doesn't really fund himself with debt, so that's a non-issue. And then, subsequently, or if you're looking at earnings because you want to see all the funky stuff in between, things cheap. The other thing I would mention too, and this is the one thing that makes me a little bit sensitive to piling in too aggressively, is he is extremely leveraged to China. If China opens back up, which, that's kind of the direction that I would like to see, because I think that the world will calm down a bit. And I like a calmer market. I know the day traders are like, no, keep the volatility going. But if China opens back up, he has factories in China that make a lot of cars that will help not just the Asia Pacific region for people that buy that product, but also because of Belt and Road, if there was any kind of, whatever you want to call it, you could get it over to Europe, but I don't know that that's how they run that business. Quite frankly, I think there's enough demand in the Asia region that he doesn't have to do that. I think there's a German facility that they'd rather do that out of. But nonetheless, you see my point. Like,
Yeah, that's a very, that's a great point.
if China opens up, Tesla should absolutely snap.
It went down in sentiment, and it made a double bottom there at 06. So,
Yeah.
262 is certainly a good target.
Yeah. At one point, this morning when it opened, it was down about 1.5 times to 2 times the market. And I was like, what the F is happening? I really think that people are under the impression that because of this Tesla Twitter relationship to Elon, they're just like, I'm just going to short Tesla, and I'm just like, why? At this point, like Tesla's kind of
Well,
all its
the
haters.
why is they think he has to sell, he has to raise 6 billion or 7 billion
Yeah.
Twitter, and he does that by selling his Tesla stock. I
Yeah.
don't know. I bet he's smart enough to have puts on Tesla.
Yeah.
Okay, next. So you read the CPI is somewhat friendly. They made a mistake on how they reported it. Is that correct?
The numbers
It's
just don't sync. They
exactly
don't
why
sync. Yeah, I think that you almost have to throw away this and wait for the revision on CPI because the numbers don't sync. Do you know what I mean? Like usually it's just so bizarre. You can't have like one number come in as expected and the annual number come in the exact opposite direction. Do you know what I mean? Like if the number came in as expected, then the annualized number should come in as expected. And if you have like this number, so X food and energy would imply that the food component is what drove you to the 8.4 on the annual number or whatever, but then you have your annual number down. Like there's got to be an error, and if there's not, I'd love to hear him explain to me how that works. Do you know what I mean?
I mean, the market's since rallied, 1,000 points. So
Yeah, I think other
there's-
people also
there's
think there
a lot
might be
of-
an error or something.
Okay.
Yeah.
Delta, that looks like a good, that's interesting at 30,
It was
50.
a really good quarter.
If you are an Amex holder, you automatically get into their airport lounge. So
Yeah.
to me, they're going after a more affluent type customer,
The business
which is
group.
smart. Right.
They've absolutely taken share from business traveling and the such. And I think that they run, I mean, like he's done a great job. His IR team, not so much. Sorry, I know you guys probably work really hard. I'm not trying to throw shade. Just call me, call Gurula. We'll help you out with your earnings releases going forward. Because I had to like literally open up the release from the previous year and try to find everything and synchronize it up to demonstrate how good the quarter was. I shouldn't have to do that. It was a really good quarter. Do you know what I mean?
Yeah, sure. Yeah.
This thing traded down. This thing traded to $27 at one point during the morning, and it should not have. It should have just traded straight up, like up 50% revenue, up 300% net income after you remove the one-time like the one-time benefit that they got from the U.S. government. Like this is,
Yeah.
I don't know what it is. They think this. What's that?
You take advantage of the market, making a mistake.
It was so weird because at first I was like, oh, let me flip my position this way because I had a strangle on and it wasn't moving. It was like kind of chilling out around the 29. I was like, oh, let me, and then I read the report and then I was like, wait a second, through my uncaffeinated sleep haze, and I was like, wait, it was I don't know why they showed the numbers this way, but that's what confused the market. First thing is my guess. I don't know why they would show it that way. I don't know why they would think that we would care that they had a $1.8 billion benefit. And so therefore we should actually consider it down 40 or something. That's crazy to me, but that's what it looked like when you first looked at the tape and you first looked at the release.
Okay. BlackRock, politically, you're saying they're pro ESG, or people taking money out because they are?
No. They had net inflows fair and square. So he was really upset because the market was pretending like he had net outflows since he lost the mandate from the state of Louisiana and a couple of other big pension funds.
Right,
And
right.
he definitely had net outflows on the equities business, except for the institutional equities. Institutional in general, he had movement from ETFs from passively managed to actively managed. So that's what it looked like on the numbers. So he was really upset because people had been before the quarter, self-included, talking about the fact that he had net outflows. I didn't say he had net outflows. I said that there was someone spitting out an index, like a whole index, and I said that because every single thing on my screen was red, which could only possibly mean that someone was literally selling every single individual asset of the index, right? So actively managed would probably hold something closer to 30, depending on the nature of whatever is being chosen, somewhere between 30, which is probably too small if it's a big pension fund, probably closer to like 100 stocks. So it'll be much more concentrated in certain types of portfolios in theory. But there is a concept of an actively managed fund that's just going under and overweight stocks throughout the S&P. So you'd still hold the 500, but you would have under and overweights, namely on things like Tesla. So it's unclear what's going on there.
Could it be they're taking money out because they're losing money?
No,
net
inflows. Fair and square, he had net inflows.
No, well, like the
No
state
one
of
took
losing.
money out. He lost money. He lost like close to 20% across the portfolio. That's what
Right,
took the 16%. And then the FX took a percent out, and, you know, that's
Yeah.
what, there was no outflow. There was just, he lost money fair and square on positions. That's it.
Well, yeah, that would cause people, I would think, big, especially pension funds to
No, they
withdraw.
gave him money. That's the thing that's
I
crazy.
know, I know that this quarter, but maybe the next quarter. I mean, I think there's a problem with pension fund. If they can't make money, I mean, the market's down. It looks to me like, how much do they manage? Like 15 trillion?
No, 7 trillion.
7 trillion. That's
7
it.
and change, almost 8 trillion at this point. They were at 10 trillion at one point, and then they've not been able to raise, because the market's been so weak, they lose more money than they're able to re-up on inflows.
Yeah, I think politically, I don't know, if I'm a politician, I'm not, I'm gonna say bad things about BlackRock.
Well, I will say that they did mention that their inflows still continue, like on the year, they're up on their ESG mandates. So that's absolutely one aspect of their business that, look,
Are you gonna give a manager more money if they're losing you money?
okay, here's the strange thing about BlackRock. BlackRock right now is a gigantic cover your butt situation for all the pension funds. The pension funds on the actively managed piece, they really go with brand names, and it's so stupid, with all due respect. This is a much longer discussion about how pension funds allocate capital. And it's for money managers, it is, especially for independent money managers, it's incredibly frustrating. I literally had this conversation with someone recently on the fact that this is just what it is. The other thing they mentioned that I do agree with, and it would make more sense, is private equity stuff. So on the alternatives business, which ends up being jumped under alternatives, depending on what the nature of that on special situations and alternatives, what will often happen is a pension fund will just give BlackRock the money. And then the crazy thing is BlackRock sometimes then gives that money to another like hedge fund. So you get 2 layers of fees. None of this is really in any, because it's
That's how
so
they operate.
like that. The asset management business is so messed up right now, and it's nobody's fault, but it's the result of 2008. 2008 made everyone that was actively managing their pension fund look like a bunch of fools, unfortunately. And as a result, all the pension funds first tried to bring it in-house and do very conservative stuff. And then 2008 through 2014 was a disaster. And so then that all started to go to like a BlackRock or some of the other companies that have, Fidelity, et cetera, that have these professionalized ways that they do it in theory. So it's just.
May we do some work for LA County Public Employees Pension Fund? All they expect is 7%. That's all they want.
That's all they want. Don't take risk. And that was the one thing they said that was
you get 7%, something's wrong, I mean.
Yeah.
Sorry.
I will say this, that the one thing they said that was very interesting, but it does not bode well for the equities market. That again is why I'm like, ooh, what is going on here? They said that a lot of the pension funds, because rates are where they are at right this minute, and it's where they are at, not just here, but overseas as well. And remember, we're talking about global pensions, especially with a company like BlackRock. So what's actually happening is, because our rates are so high, and you got to remember, you're not allowed to do lack of risk. But if you lever the US Treasuries a certain way, that's actually not considered as risky as going into equities, strangely enough, once you do some of the math on it. It depends on how you actually structure it. But technically you can get, if the yield is at 4% and you lever it, you get more than 4%, right? So you can get your 5 or 6% that a lot of pension funds need, and then use the rest of the portfolio to try to get whatever will mathematically get you to whatever it is you owe on your liabilities. That's a real thing that happens. I'm not even confused that this is true. Try me on it, right? But they said that because of where rates are at in the fixed income markets, that's where they would anticipate different products to become popular for the institutional money. But that's not good for equities, because that means the allocation away from equities into other asset classes.
Yes.
Does that make sense?
Yeah.
How I said it?
Yeah. Well, but I mean, the 60-40 model is terrible. That's
always terrible. Yeah. as soon as rates dipped below what your liability is as a pension fund, the 60-40 model ceased to make sense. That's 100% correct. Because you'd never be able to pass the hurdle without taking huge leverage or some kind of funky risk. But right now with rates where they're at, you know, and it became increasingly painful until rates got almost to 2%. And then it was just like people got fired at pension funds, for lack of a better way to say it, you know? Yeah, but now with rates increasing and you've got the foreign currency thing for some of the European pension funds, are whatever percentage rate on the long end actually looks much higher to them if they had purchased it and then watched their currency decline in value.
Got it. Thank you. Brilliant as usual, man. Thank you very much.
All right. Bye, everybody.